You probably use a bank almost every day, whether it's checking your balance on your phone, swiping your card at the store, or taking out cash from an ATM. But have you ever stopped to wonder what your bank is actually doing with your money? Why don't they just keep it sitting in a vault for you? How can they lend out way more money than they actually hold? And if banks are supposed to be safe, why do they sometimes collapse? In this video, we'll break down how banks really work, where your money goes, how lending and interest shape the system, why banks are so important to the economy, and what happens if everyone takes their money out at once. So, let's get started.
What is a bank? A bank is simply an institution that manages money, both yours and other people's. But calling it just a place to store cash is like calling your smartphone just a phone. Sure, it can make calls, but it does so much more. Think of a bank as the middleman of money. You deposit your paycheck, and instead of sitting in a dusty vault, that money gets pooled together with millions of others. This pooled money then powers lending, investing, and payments across the entire economy. Here's a simple analogy. Imagine your bank is like a giant community piggy bank. Everyone tosses their coins in, but instead of just sitting there, the piggy bank actually lends those coins out to help someone buy a car, start a business, or build a house. Look at the Medici Bank in 15th century Italy, one of the first modern banks. It didn't just store gold for Florence's wealthy families. It became the financial engine behind trade across Europe. Fast forward to today, and banks still play the same role, just with apps instead of ledgers and gold. The cause and effect here is simple. Because banks exist, money doesn't just lie idle. It moves, it grows, it creates opportunities. So essentially, a bank is not just a vault, it's a system that takes in money, circulates it, and powers economic life. But here's the big question. If banks don't just keep their cash locked away, what do they actually do with it?
How banks really work. When you deposit $10 in your account, your instinct says the bank just tucks it away with your name on it. But in reality, banks use something called fractional reserve banking. That means they only keep a fraction of deposits on hand, and the rest is used to make loans. Think of it like a coat check at a theater. You hand in your coat, and you expect it back later. But imagine the coat check guy lends half the coats out to people who are cold outside, trusting that not everyone will ask for their coat back at the same time. That's basically how banks operate. For example, in the US, banks may only be required to keep around 10% of deposits as reserves. So if you and millions of others deposit $1 billion in total, the bank might only keep $100 million in cash. The other $900 million, it's lent out to home buyers, students, or businesses. This system works beautifully most of the time, but the 2008 financial crisis showed its fragility. When too many people try to withdraw money at once, or banks had made risky loans that collapsed, the whole system nearly froze. So in essence, banks don't keep your money sitting still. They recycle it into the economy. But that raises another question. If your money is constantly moving, where exactly does it go?
Where your money goes. When you see your account balance on your phone, it feels like your money is there. But in reality, that balance is more like a promise, an IOU from the bank saying, yes, we owe you this amount. Here's an analogy. Imagine giving a friend $20 to hold. Instead of just keeping it in his pocket, he uses it to buy supplies for his small business. But he promises he'll always have $20 to give back to you when you ask. That's what banks do with your deposits. They put them to work. A lot of your deposited money goes into loans, mortgages, student loans, car loans, business loans. Another chunk goes into investments like government bonds or corporate securities. And a small part stays as reserves in case you or others want to withdraw. For example, if you deposit $1,000, the bank might keep $100 in reserves, lend $600 to a small business, and invest $300 in government bonds. Each of those moves generates income for the bank through interest or returns, while still letting you see your $1,000 balance. This is how banks can pay you a little interest on your savings while making bigger profits on loans. But, of course, if too many borrowers default, banks can get into trouble, as we saw with the mortgage meltdown of 2008. So your money is never just sitting in the bank. It's always moving, growing, and being put to use. But this leads to another question. How exactly does lending and interest make this system tick? How lending and interest shape the system. Lending is the lifeblood of modern banking. Every time a bank approves a loan, it's essentially creating new money. Interest is the price of money. When you borrow $1,000, the bank charges you, say, 5%, meaning you'll pay back $1,050. That extra $50 is the bank's profit. Think of it like renting an apartment. You borrow the space, and you pay rent for using it. A post-2008, central banks slashed interest rates close to zero. This encouraged banks to lend more, people to borrow more, and economies to recover. On the flip side, in 2022-2023, central banks hiked interest rates sharply to fight inflation. This cooled down borrowing. Mortgages became expensive, credit card rates soared, slowing the economy but taming prices. So the chain reaction works like this. Banks lend money, borrowers spend it on homes, businesses, education. That spending fuels jobs and growth. Borrowers repay loans with interest, banks profit, and the cycle continues. So essentially, interest and lending are the gears that keep the banking system spinning. But now comes the big picture. Why are banks so crucial to the entire economy?
Without banks, our modern economy would look completely different. They don't just move money, they multiply its impact. Banks are the bridge between savers and borrowers. They take idle money from one group and channel it into productive uses for another. Imagine a soccer game without a referee. Sure, players can kick the ball around, but there's no structure, no flow. Banks are like the referee. They don't score goals themselves, but they make the game possible. Take the Great Depression of the 1930s as a case study. When thousands of banks collapsed, businesses couldn't get loans, people lost savings, and the economy spiraled into disaster. That's why governments today tightly regulate banks with deposit insurance, stress tests, and central bank oversight to avoid total meltdowns. When banks lend, businesses expand, people buy homes, and jobs are created. When banks fail, credit freezes, investment stalls, and economies crash. Banks are not just places to store money. They are the arteries of the economy, pumping funds where they're needed. But understanding this system also raises a deeper question. What happens when trust in banks breaks down entirely? That's where crises and sometimes revolutions begin.
What happens if everyone takes their money out at once? This scenario has a name, a bank run. It happens when too many people panic and try to withdraw their money all at the same time. Remember our coat check analogy earlier? Imagine everyone at the theater rushing back for their coats at once. The coat check guy only has a fraction of them on hand because the rest are lent out. That's exactly the problem banks face. A bank run is when withdrawals exceed reserves, causing banks to run out of available cash, even if, on paper, the bank is still solvent. Think of a crowded restaurant that takes reservations. They know not everyone will show up, so they overbook slightly. But if every single guest arrives, there aren't enough tables, and chaos breaks out. The Great Depression in the 1930s saw thousands of bank runs across the United States. People lined up outside banks, desperate to pull their money. More recently, in 2023, Silicon Valley Bank collapsed in just 48 hours after customers yanked out $42 billion in deposits. Technology made the panic move faster than ever before. Bank runs show just how fragile trust in the system can be. As long as people believe their money is safe, banks function smoothly. But the moment confidence breaks, even the strongest bank can crumble overnight. And that's why governments created deposit insurance, central bank safety nets, and strict regulations to stop one bank run from turning into an economic wildfire.
So, in conclusion, banks aren't just vaults that guard your cash. On one hand, they give us a safe place to store money, create loans, and fuel businesses. But on the other hand, they only hold a fraction of deposits, depend on trust, and can collapse if that trust disappears. Your money isn't sitting still. It's constantly being lent, invested, and multiplied through interest. But maybe the bigger question is, if banks are this powerful, who really controls them, and who benefits most from the system? If you want more clear and simple breakdowns like this, hit like, subscribe, and join the flock here at Economics 101. Thanks for watching.